Hello and welcome to the Silver Log, and this video will focus on the dollar index, two different charts, the first being the daily, the final being the quarterly. This shows the last 50 periods, and the Fibonacci for the last 67 periods and the running averages. Within this market, it was in a downtrend until this occurred. A large size move that got it above this area, thus changing the direction to that of bullish. And now it's back down and having its first test within this 18 period average of high, lows, and closes. It's not hanging in there. Normally, when you're in an uptrend with the rising average like that and you're within this level, then you would be cautiously bullish. I can't make this the case. Why? Because of this Fibonacci level. This Fibonacci recognizes the last 67 highs, and it needs to really confirm a break above this to say that the selling was a failed move. It has not done so. Thus, it's not showing much strength whatsoever. You find resistance here and pull back, that's fine. Now you get above it. Question is, you need to find a higher low. Either the higher low can be here, and even here, this would have been fine to have a higher low here from this low and then continue higher, but nope. This was a huge candle, really showing signs of okay, hello folks, something's going on here. This is like a caution day situation when you see this movement. The silver market, gold markets are barely up today, yet the currency lost almost 1%. And when you look at the size of the candle, it's really the biggest down day we've had, at least within the last 50. It's comparable to this move in here, which occurred at the end of April, which thus triggered the intermediate term top on gold and silver. Therefore, we're at an area where maybe we come back up here, find a higher or a lower high, maybe at this little area of former resistance, but it's not looking too strong. And whenever you have a situation where you reverse the trend, you're in a big downtrend, because if this Fibonacci is here, then that means we were way higher before. And you finally reverse this 18 period average, make it go higher, and this is all you get, then that's a failed move. And oftentimes failed moves can create fast moves in the opposite direction. And if that's the case, I'd be looking for a test at least down towards this previous low of 72 3/4. Moving this on to the quarterly chart. This is going back to the late 1990s, each one representing 3 months worth of data. Same thing, last 50 days, 67 candles, making this the Fibonacci level. You were in an uptrend in here, which then got switched to cautiously bullish. And here you get neutral, neutral with a down bias, and then boom, now you're neutral. Or excuse me, now you're bearish in here. And you're bearish for quite some time as the market moves from 95 down towards 70. The resistance level here, it came up towards this Fibonacci and this declining 18 period average, found resistance, came back, found a higher low, but it still didn't break it. Because that's what I've often said a lot of times. When you're at an area where you expect to find resistance or support, in this case resistance, then you want to pull back, find a higher low, and then increase the chances of having it. Well, that, even though with an increased chance, it still didn't happen. And when you find resistance twice at the area, and now you're making new lows not seen since in here, that's a very bearish sign. Also, 80 is a big level. When you look even further, going back to the 80s, the 70s, and even other parts of the 90s, this 80 level is very big. To find out more about this, search Endless Mountain Dollar Index. Maybe it's related. I've talked about in at least 2 videos in the past how big that 80 level is. So what we see here is we have support, and then it broke below here. Thus, this is a bear trap. And the reason why it's a bear trap is A, it goes through a significant support level, which was 80. B, it goes down a decent amount, which was the case. It went down 10 handles or 10 points, 15%, 12, 13%. Regardless, it went down a decent amount, came back up and didn't find resistance where it was supposed to. Instead, it went higher. There you go. There's the bear trap. There's a failed move. Oftentimes, failed moves create fast moves in the opposite direction. This wasn't one of them. There was no fast move in the opposite direction. It made it up here. So now this is showing us now to be that failed move. These little moves in here, and oftentimes from failed moves should create fast moves, and it's not a test of 70, although maybe it bounces a little bit there. but it should be a break into the 60s. Where it finds support, 62, 63, 58, 65, I don't know. But the market is showing signs of really breaking down. And as far as an entry point, this candle here, the current one, is showing us the entry. There's still another month and change for this candle to develop. But if this candle has a red, if it's as long as it's a red candle, I'm going to really be thinking that this summer and fall, that this is really going to break down. And the US dollar index is not a good measure to see how currencies are doing. No, the best way is through inflation and see how real products are doing within every currency. Because Canadian currency or the US currency is matched up against the Canadian dollar, the euro, the pound, maybe the Australian dollar. I don't even think maybe the Australian dollar. The what other one is Switzerland, I think. Well, there's a bunch of currencies. They're all having inflation. They all have the price of gold and silver going higher. Therefore, this is a measure of junk against other junk. Another junk, another junk. And what we're seeing now is this junk is worse than the other junk. That's why I like the physical silver, because that's real assets that can't lose its value through monetary inflation. Alright, that should be it for this video. Thanks for tuning in, and have yourself a magnificent weekend. Bye-bye.